Hi, and welcome to this week's look at the major news stories that have affected the market so far. And what are we going to be taking a look at? Well, firstly, we're going to look at the UK stock market reaction to the latest inflation data. We're going to take a look at how the US markets, particularly the S&P fared after the release of the Fed report. Then we're going to take a look at stagflation. Is it in the UK and what is it? And finally, we're going to take a look at the oil price and a bit of a correction there, hopefully, and take a little bit of pressure off of inflation. So to start with, we had inflation data out in the UK this week, and the FTSE 100 rose off the back of it. So data was published on Wednesday, 4 August, and we saw CPI at 6.7%. It was actually expected to be 7%, a slight uptick compared to the previous month's 6.8%. So this reduction was a bit of a surprise and potentially good news. Now, the expectation was for it to go up off the back of energy prices, but it's actually the 6th month in a row that it's either gone down or stayed the same. Still a long way off the Bank of England's target of 2%, but does this show their strategy is beginning to work? Well, the reaction we saw was pretty much as follows. Sterling against the dollar fell to another September low, and in fact, approaching the important low from back in May of this year. Not really a surprise, we still have the highest inflation in the UK of any major nation, but the FTSE 100 went off the back of it. Now, if we look at the chart, what does it show us? It's a 4-hour chart. Well, bullish signals, well, the bulls could gain a foothold above the 7,700 psychological level, and the price is within the ascending channel, shown in blue, and a confident return to its upper half will indicate some strength of demand. Bearish signals, on the other hand, though, 7,700 offers some resistance. We saw that at the end of July, where the bears basically won the battle at that level. And exceeding the July high may be a false breakout. That's possible after the initial positive reaction to the lower inflation figures, that the market consensus will indicate a fair price below 7,700. And in fact, there'll be much like the EUR Stoxx 50 reaction last week to the ECB decision. A brief period of positivity followed by settling back down. And of course, we got the UK interest rate decision due out Thursday. In fact, that has literally just come out and they've left the interest rate unchanged. Be interesting to see how the markets react to that sort of added in piece of information as well. But certainly I think we're in for a little bit of volatility in the coming months, so don't forget your risk management techniques. Okay, so we know how the FTSE reacted to inflation news in the UK this week. And what about the US? We had the Fed report out Wednesday evening, and the S&P fell off the back of it. So what did the report say? Well, basically, according to Jerome Powell, who of course is the head of the Federal Reserve, the full effect of the monetary tightening policy has yet to be felt. No massive surprise there. And they will continue to act cautiously based on the incoming data. Again, we've heard that before. Inflation, obviously, much higher than the target still. Now, opinions seem to be divided on whether the Fed will tighten further. JP Morgan analysts, for example, think the rate cycle is over, whereas Vanguard analysts think that there will be another rate hike, and in fact, potentially more than one. So maybe the repeated rhetoric, as I say, what Jerome Powell said, we pretty much heard before, is no longer being taken as a sign of confidence. Could be one of the factors here. And the US market certainly fell off the back of it as a recession scenario becomes more and more pressing. So what are we looking at? Well, bearish indicators. Resistance is now expected at 4,400 level. Now, the rising channel has been broken, which confirms the weakness of the bulls, and potentially maybe that hype over AI that we've spoken about is over. Looking at the chart, we can see there's a decrease in the amplitude of the oscillators A to B to C to D that we've seen since the end of spring. That seems to have ended. And traditionally, of course, the end of September is the worst period for stock markets. None of these factors looking particularly great. On the flip side of that, bullish indicators. But the price of the S&P 500 may well find support near the median line of the descending channel that you can see. And support may also be found at the 43.50 level, where bulls had a clear advantage earlier this summer. But again, nobody knows for sure. Certainly economic data coming in is going to drive most of the decisions that we're going to see. And it is, as we've proven there, pretty much a divided opinion if the rate hike cycle is over or if there's going to be continuation. Right, we're just going to flip our attention back to the UK for the moment. And despite, positive inflation figures this week. Is there stagflation in the UK? In fact, euro against the sterling volatility may be a slight indicator of that. Now, so far, the dreaded recession has been averted or avoided in the UK, but lurking in the shadows is stagflation. What is stagflation? Well, it's a quagmire or a mix of high inflation, check, we've got that, low economic growth, yeah, and high unemployment. The UK has been giving mixed signals over the past month or so. The economy outpaced expectation in the second quarter of this year. Well, that's a positive sign. Consumer confidence saw an uptick pretty much off the back of that, and public borrowing defied the pessimistic projections, particularly off the back of tax receipts. So we'd take that as a positive. On the other hand, PMIs plummeted to the lowest level since January 2021. Now, purchasing manufacturers indexes are a key indicator of growth within the economy. Sales figures at the same time have been pretty lackluster. And importantly, unemployment levels, which was once pretty dormant even with high inflation, have begun their ascent. Now, the euro sterling increases may be a symptom of uncertainty. We're trying to break the psychological resistance level near 0.8670. And it's been moving in an upward trend since September the 6th. Again, uncertainty about the stability of the pound. Stagflation can cause wages to surge rapidly as well, and that's really quite important because in the UK, 3 months to June of this year saw the fastest wage growth on record. Now, inflation, whilst we said has had a surprise decrease this week, is still very, very high. And in fact, wages are up 21% since February 2020. Though if you do adjust that for the full effects of inflation, they're virtually the same. Now, in a period of stagflation, nominal indicators like wages and taxes increase at a much faster pace than indicators such as PMI and GDP. Now, it's clearly being mirrored in the UK over the past few months. This is a bit of a major concern and in fact may well have contributed to the Bank of England holding rates where they have done just today, Thursday. What's going to happen moving forwards, I don't know, but fear of recession is there, fear of stagflation is there, and we still have the highest rate of inflation of any major economy in the world. Could be a very bumpy ride. Finally, we're going to turn our attention to commodity and take a look at oil. And we're finally seeing a bearish reversal in the oil price. Worth noting that one of the expected reasons for an uptick in inflation in the UK this month would be higher oil prices. And obviously didn't quite have the impact we were expecting. But certainly the policy of OPEC plus countries to reduce production has been one of the main drivers of WT oil, for example, increasing approximately 40% from their June low. So I think it's fair point to, it's appropriate to ask if a correction is overdue. Well, this week, we've seen a decline from the high above $92 per barrel to current levels approximately $88.50, so that's $88.50 per barrel. Note the reversal began with extremely high trading volumes on the NYMEX exchange on Tuesday of this week. So what does this sort of tell us? Well, bearish signals, price increase from B to C that you're seeing on the chart is near the Fibonacci level of 31.8% of the decrease A to B. And this would be acceptable for a natural rollback. The psychological level of $90 per barrel can now act as resistance. And the price, as we can see, has broken through the median line of the uptrend, which could well now provide further resistance. And the $89 per barrel level, broken by bears, may well slow the bulls down if they're looking for an uptick. Flip side of that is always, the opposite opinion. What are we seeing from a bullish perspective? Well, certainly we're going to expect some support around the $87.50 per barrel mark. That support line, which was former resistance that restrained growth at the beginning of this month, is now looking to turn around, and that will be supported also by the lower channel line that we can see. We've also had an article out from the Financial Times this week that said hedge funds are aiming for the price to reach $100 per barrel. Well, they have cast a bit of doubt on that because they're saying due to the sharp change in prices, the volumes and the assessment of the impulse movements, that may well not occur. But it does seem as though some of these players, hedge fund players, are looking for a significant uptick in the price even further. We know there are a lot of factors to play in the oil market. We've obviously got OPEC plus controlling supply. We've got reserves which you need to keep an eye on over in the US being at very, very low levels. Again, it looks like a period of uncertainty and a period of volatility for the oil market. So as with any market, Don't forget your risk management techniques, and we wish you luck with your trading in the week ahead. Bye for now.